My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to help make a little money. My job is not just to entertain, but to explain and to educate. So call me at 1-800-743-CBC or tweet me at Jim Cramer. This market is just addicted to growth. It can't stay away from it. After a day or two of flirting with the industrials and the retailers, the money flowed right back into the largest of the large caps, the growth behemoths now known as the Magnificent Seven, along with their fellow travelers, and that was the source of strength on a truly middling day. Dow dipped 5 points, S&P advanced 0.37, the tech-heavy NASDAQ, chock full of these kinds of names, jumped 0.95%. And while it doesn't happen all at once, the Magnificent Seven, Amazon, Apple, Alphabet, Meta, Microsoft, NVIDIA, and Tesla, stand out as the drivers of 2023. And after a quick dalliance away from them, once again, there seems to be no end to the levitation of these stocks. Will you look at this? Is there anything on the horizon that could change this dynamic? Why don't we go to our game plan to find out? Now, tomorrow, the only thing of any real note is a company that's going to approach called CarMax. It's a giant used car dealer, and I think it's going to fare pretty well here. We're beginning to see more daylight between the new and the used car prices, and that's when CarMax makes the most money. But the next week is full of tales, as I like to call them, stocks that might give you valuable insight into what's really happening out there so you can manage your own portfolio better. Right now, we're all pretty much sure that the consumers moved on from goods to services in this post-pandemic world. Makes sense. Remember, we are all long on money and short on time. Please don't forget that. That's been my wrap on the post-COVID economy for a while now. But there's no better test of that thesis than we hear from Carnival. Yes, this company was once considered COVID ground zero. Remember, they used to call it the Petri dish? But now it's sort of like it was like before the pandemic. It's a fun, inexpensive vacation, especially if you can hold your liquor. We need to pay close attention to when the company talks about future bookings on the call to gauge how much longer this travel and entertainment boom can continue. That will be crucial. Now, Tuesday, oh, this is a tough one. Walgreens Boots Alliance. This stock has been horrible. Today I saw some research that said this Dow component is so hated that with its 6% yield, it could actually bounce, even reported just an in-line number. I agree, but I believe Walgreens has a problem with what's known as shrink. That's a great euphemism for mysteriously vanishing inventory, usually due to pilferage. That problem is getting worse, not better, especially because they now have to lock everything up and force you to wait for a struggling worker to come over and open up the plexiglass. And by the way, it's not the best shopping experience. Look out, Amazon Prime Day could be a vicious hit for their sales. Wednesday morning, we hear from General Mills. We used to call it Generous Mills, and I think it's reporting at the right time, as there's a wave of money coming back into the staples for fear of a Fed-induced recession, something Fed Chief Jay Powell did not place odds on, but the market does. I kind of put those kinds of bets on every day. I mean, did you see PepsiCo is up almost $2 today? And when that happens, General Mills barely up at all, well, that makes me want to buy Mills into Wednesday's report. Wednesday morning, we also want to pay attention to central banker meeting. And get this is terrific. It's a panel of world central bankers, and it's held by our own CNBC's Sarah Eisen. I think Sarah could ask whether the government stimulus has been too great, hurting the Federal Reserve's ability to maintain price stability, something I will address later in the show. Her panel will be must-watch TV. After the close, we get results from one of the most important stocks in the entire market, Moo. That's right, Micron, the maker of basic DRAM chips, the building blocks of all memory. It turns out that ChatGPT and its generative AI offshoots use a gigantic amount of memory. Well, SK Hynix has the leg up in this particular portion of the DRAM business. That's a real good competitor, Micron. I sure wouldn't fight anyone who wants to own a piece of Micron right here. I think CEO Sanjay Mehrotra from Micron has been very conservative and reluctant to spell all the good news that AI, particularly generative AI, could bring to Micron on the earnings front. He's just not like that. But I am telling you, I think this stock will prove to be very undervalued versus its 2024 prospects because of generative AI. And that's how you have to analyze this wild trader. Next, if you think the economy's slowing, I mean, a lot of people, the Fed's sure trying, right? What do you reach for? You reach for McCormick, the spice company. And its affiliates objective with a run to near 52-week high earlier today. Look at this thing. This thing has just been amazing. Down here, of course, everyone was worried about the earnings. But then, boom, and everyone's worried about a recession. Now, it wasn't that long ago that McCormick missed a couple of quarters and Wall Street turned against one of the most reliable companies on earth. We more or less kept the faith. Betting that CEO Lawrence Kurz's condiment and sauce acquisitions made a ton of sense. And now that view is paying off. I like to take the temperature of small, medium-sized businesses by looking at the results from a company called Paychex, the payroll processor focused on smaller enterprises. So far, there's been no cessation of hiring from this cohort that we've seen. Even though we constantly hear how the banks might tighten credit and small business owners are in trouble, Paychex has kept us informed about the continued strength here. They don't see it. Wherever I go, I hear money managers say small and medium-sized businesses are threatened by the Fed and by the endless rate hikes. To date, that simply hasn't been true, at least not according to Paychex, and they should know. Let's see if anything's changed. After the close Thursday, we hear from the most important company of the week, and that's Nike. I think that they have a darn good long-term story, but there are some roadblocks in the short term, like a retail slowdown in China and to some degree the United States. For the first time, I'm beginning to hear a real competition Nike from the likes of Hoka, and that's owned by Deckers, and more important, On Holdings. On Holding, which is doing remarkably well, winning over both runners and casual wearers. I think On, as we call it from the symbol, sold off too hard after that last quarter, and there's a buy right here. I do want to recommend Nike, but we need to get past a forecast that may be more tepid than usual. Please, if you're a trader, wait until you hear the forecast on the conference call before you pull the trigger, because Nike's a forecast stock, not a result stock. Finally, on Friday, confusing one. We get earnings from Constellation's brands, STC. Now, Constellation is the maker of Modelo, which just displaced Bud Light as the #1 beer in this country. Now, one by one, the analysts have praised Constellation, which is, by the way, owned by my charitable trust, but it hasn't done that much to lift in recent weeks. Now, we told members of the CNBC Investing Clubs, both in our morning meeting, which is at 10:20, and then our meeting a little bit after 2, we called the 2-ish, that the stock is signaling by its own tepid action that it's going to miss the quarter. Now, what do? I don't know. All I can tell you is that while I think it's going to be great long-term for cash flow, I don't like the action. Bottom line, it's an important week, not to be minimized. As we make our way to July for an employment report, a Fed meeting, and a parade of earnings, all care of an upcoming calendar change. Larry in South Carolina. Larry.
Hey, Jim, I love your show.
Thank you, Larry. What's up?
I just wanted to tell you how much I liked when you said, hey, stop scaring people about interest rates. That was great.
Thank you. I just don't. I hate it when people cause panic. It drives me crazy. How can I help?
Exactly. I'd like to know what you think about KHC as a hedge against inflation.
It's a decent hedge. It's just not well run. And I don't want to own a not well-run food company when I have a Campbell's that is all the way down, a Kellogg that's doing a split mode, and a General Mills that will report next week. For that matter, McCormick and even PepsiCo. They are all better than Kraft Heinz. Thank you for the kind comments about my interest rate call. Let's go to Billy in North Carolina. Billy.
Hey, Jim, and thank you for your time.
Of course.
My question is on Target. I'm in Target at 77 a share. I rode it all the way to the top during the pandemic, broke a major investment rule of yours, and rode it all the way back down to where it is now. I still have a profit of about 55 a share in it, but I let go of a lot of that because I didn't sell when I should have. I'd like to know what I should do with it today. What are your opinions on the stock?
All right, first, Billy, stop kicking yourself. A lot of people made that same mistake. And who saw these problems with Target and the political backlash coming? I know I didn't. Here's what I need you to know. 3.3% yield, good balance sheet. Brian Cornell's a good merchant, 15 times earnings. I'd rather buy it than sell it. Anthony in Michigan. Anthony.
Hello, Dr. Cramer. How are you?
I am fine. How about you, Anthony?
Oh, quite well, thank you.
Good.
Since Dr. Buffett has stated that Berkshire Class B shares would begin to slow up, what do you recommend for the stock, A, and then B? Why don't you have it in your portfolio?
Okay,
as well?
that's a really good question. It's very hard to find out about Berkshire Hathaway. They don't do traditional conference calls. They do a once-a-year annual report. It is a very good company. It's an industry conglomerate that's very hard to know. It's being driven right now by Apple, not anything else, frankly. And I do like the Berkshire B. I think it's good. I've been recommending Berkshire Hathaway since the show started in 2005. So I think you're okay. Monty in Florida. Monty.
Hello, Mr. Cramer. Thank you for taking my call.
Of course, Monty. What's going on?
I have a new expression for you. The more you learn, the more you earn. So therefore, I enjoy listening.
I like that. Yeah, I like that.
Okay, good. Feel free to use it anytime.
Okay,
I have
I'll steal
a question
it.
for you.
I'll steal it. I mean, people,
Okay.
they might not know it came from you. You don't mind that, or I'll just use it, right?
Absolutely not. My
All right,
pleasure.
listen tomorrow morning, you squawk on the street. You're going to see me take credit for what Monty in Florida just told me.
Right, my pleasure. Anyway, my question for you is on Qualcomm.
Yeah.
Due to the AI infusion, obviously, of a lot of stocks, Qualcomm has been kind of in the laggards, to say the least, over the last year or so. And I was wondering what your thoughts were on buying.
Okay, Qualcomm, it is an inconsistently managed company, and is also a company that is given to what I can only say is hype. And I don't like hype. I don't like hope. I like facts. And that one just doesn't fulfill my dream. The market seems like it's clinging to the Magnificent Seven. And the days ahead could tell us that trend is going to just continue and continue and continue. Oh, man, tonight, just over a month ago, I told home gamers that we were getting a buying opportunity in defense contractors. So after a nice run up in the sector since the call, I have one particular player that I think is still worth paying attention to. I'll reveal it. Then we've had a few tough days in this bull market, so is your portfolio prepared to handle whatever is coming? We're going to play MI diversified. And to see if you can handle whatever the market throws, you know you got to be diversified. Plus, hey, you called in and you stumped me on RadNet. So tonight I'm turning in my homework on the medical diagnostics company, see if it could be a rad investment for your portfolio. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.